Welcome everybody to the special session on COVID-19. Let me just say the webinar is open to the public. It's recorded and it's actually being live streamed right now on YouTube as we speak. Everybody is welcome to ask questions, but during the talk, I would just feel free to type your questions in the chat box, but not in the Q&A box because we're not monitoring the Q&A box. And there was gonna be roughly 10 minutes Q&A session, and the panelists would ask you to raise your questions if you raise your hands. Today, we're honored to have Professor Stijn Van Nieuwerburgh to give a special session on COVID-19. The title of the talk is, Can the COVID Bailout Save the Economy? I also like to welcome to our panelists, Professor Avril Ravid from Yeshiva University, who's our outgoing president at the MFA, and Professor Stefano Giglio from Yale University, who's our academic director at the MFA. Stijn is the Earl W. Kaziz and Benjamin Short Professor at Real Estate and Professor of Finance at Columbia University. His research spans housing, asset pricing, and macro. He has a long list of publications disproportional to his age. And these publications virtually covered all top journals in economics and finance. He's an editor at the Review of Financial Studies. He's a faculty research associate at NBER and the Center for European Policy Research. He also served as an advisor to the Norwegian Minister of Finance. He's been a visiting scholar to numerous regional and central banks around the world. Professor Van Nieuwerburgh was awarded the 15th edition of the Bernard-Sear Prize for his research on the transmission of shocks in the housing market to the macroeconomy. The Bernard-Sear Prize is awarded annually to a European economist under the age of 40 who has made significant contributions in macro and finance. So without further ado, let me give the floor, give the screen actually to Stijn.
Thank you, Henji, for that kind introduction. Let me share my screen with you. You give me a thumbs up?
Yeah.
Okay, great. Thank you so much. So it's my great pleasure today to be with you and to talk about COVID and the government's rescue program that was mounted in response to it. So this is based on a paper that we wrote kind of in the midst of the pandemic in April and in May with Vadim Alanov, who's at Johns Hopkins University, and Tim Landvoigt, who's at Wharton. And so, you know, as we all know, the coronavirus pandemics shut down large parts of the economy and, you know, really put a lot of strain on corporations. And, you know, it's probably fair to say that many businesses, you know, were definitely bound to fail without government assistance, especially smaller companies that might be short on cash, short on liquidity, you know, as these businesses saw themselves kind of simultaneously unable to make wage payments, rent payments, as well as service their existing debts. And so what we are interested in is kind of this connection between corporate default and the financial system, you know, call it, you know, banking default. And so what we've learned from a lot of research by, you know, Reinhard and Rogov and Mian and Sufi and many others is that, you know, most deep, Shularik and Taylor, is that most deep recessions tend to be also financial recessions, right? They tend to be financial crises where there's kind of a simultaneous breakdown in kind of the corporate or the household sector as well as in the banking sector. And so this doom loop of corporate defaults, you know, spilling over into the intermediary sector is something that we're particularly concerned about and is, you know, particularly strong rationale for government intervention. And so that's indeed what we saw. We saw the government kind of making, in some sense, unprecedented commitments to the corporate sector through a variety of programs. The ones that you're probably most familiar with is the Paycheck Protection Program, or PPP, which essentially gave, you know, direct assistance to corporations as long as they kept their employees on the payroll. And essentially were forgivable loans, you know, as long as the money was used for keeping these employees, for paying wages, the corporations didn't have to pay back. There's a range of other programs though. The Main Street Lending Program, MSLP, kind of makes loans to medium-sized companies. And then the corporate credit facilities, which I'll describe in some more detail, make, you know, basically target larger corporations, and they kind of intervene in the corporate bond market, both in the primary and in the secondary market. And so what we want to ask in this paper is, how effective are these policies? Were these policies? What would have happened in the absence of these policies? And related to that, what are the fiscal costs of these programs, relative to the counterfactual, where we wouldn't have had these policies in the first place, right? And so we also want to think not just kind of in the short run, let's call it 2020, but also kind of longer term. What are the implications of kind of both the shock that we went through, as well as the government response for kind of the long run behavior of the macroeconomy and financial markets? So, in a nutshell, we want to quantify the effectiveness of these lending programs relative to this do-nothing counterfactual. We're going to lean heavily on, prior research that we've done, where we've built a rich model at the intersection of the corporate sector, the intermediary sector, as well as the government. We have a prior paper, which actually yesterday we learned is forthcoming in Econometrica. And we're going to extend this model in a variety of directions, but most particularly, we're going to incorporate, these lending programs, these governmental programs, both kind of one by one, and kind of the policy combination that we've seen in the real world. And then we're going to analyze the macro financial and fiscal impacts of these policies after the COVID shock. Now, in a nutshell, what we're going to find is that these programs softened the contraction substantially. Okay, so they were highly effective, and by our calculation, they avoided something like 40% of corporate defaults. They avoided something like a third of the drop in GDP and consumption compared to this counterfactual, where the laissez-faire, where there was no intervention. They lead to a 50% smaller decline in investment. And we also find that absent these programs, something like 40% of the intermediary sector would have collapsed. And that would have triggered like a massive government bailout, not unlike what we've seen, or maybe even worse than what we've seen in the great financial crisis. Now, with that, what we find is that there's a rising government debt that comes, with these programs. These programs do not come for free. They do not come cheap. So the government needs to spend money in the current year, and that adds to the debt. But one interesting finding is that even in the absence of these programs, the government would have instead had to spend essentially the same amount of money to bail out the banking sector. So in that sense, it's a net zero operation. I mean, yes, the deficit goes up by 20% of GDP in 2020, but that would have happened anyways, even absent these programs. Okay. Now, what we find in terms of which of these programs works the best, what we find is that a forgivable loan, as in the PPP program, is the most effective. The Main Street Lending Program, which is essentially a bridge loan program, also is effective at staving off corporate defaults, but not quite as effective because it's not a forgivable loan. And we find that these corporate debt market interventions through the corporate credit facilities, the primary and secondary market corporate credit facilities, come in third. They're kind of the least effective in our model, but they still have a positive effect. And kind of combined, what we find is that something like 6.5% of a 6.5% increase in aggregate welfare to the households in the model, compared to this do-nothing scenario. So kind of a very successful intervention from that perspective. We're also going to study kind of an idealized program, a hypothetical program, where the government was able to target, would be able to target much better which firms exactly need help. And what we find is that program, would have been much, much cheaper to implement from a fiscal perspective, but would have, only marginally led to, larger welfare gains. So overall, our conclusion is that the policy combination that we've seen was pretty good, pretty close to, what's arguably an unattainable targeting of the program. And then the last thing we do in the paper is to kind of take a longer term perspective. And we basically ask, so in most of the results I'm going to show you, the thought experiment is that there's kind of this 1 year COVID shock in 2020, and then it goes away. But in a second set of calculations, we are assuming that, once the pandemic hits, first of all, it's likely to last for another year. And second, from that point forward, there's always going to be a probability of pandemics in the future. Even though it's a small probability, you can think of this as kind of like a disaster model. From now on, pandemics are going to be like 1% probability events forever after. And we show that has interesting long-term implications for the economy, as well as kind of short-term implications for the behavior of interest rates, which are markedly different between our new normal and old normal calculations. So just to motivate us a little bit more with some data, and this is data you've probably seen in some format or another, there was and there is a lot of distress in corporate credit markets. For example, CLO prices fell something like 20%. They fell more in sectors of the economy that were more directly affected by COVID, like the hotel industry or the transportation industry. They also fell more for high-risk bonds, like lower-rated tranches of these CLOs than for investment-grade tranches. Just looking at corporate credit spreads, you see here AAA, BBB, and high-yield corporate credit spreads. You see that these credit spreads essentially tripled, reached highs that we hadn't seen essentially since the Great Financial Crisis. For example, the high-yield spread went from below 4% to something like 11% in around March 23rd. And then after the government intervened on March 23rd, you might remember there was a second major Federal Reserve Bank announcement where all these programs were set up. The government successfully managed to kind of stem the panic in the credit markets, and these credit spreads started to come back in to compress again. That said, even today, they're about 50% higher than they were before the pandemic. And then the last thing we were interested in is just kind of actual corporate bankruptcies. Now, it's arguably still a little bit too early to kind of know what's happening, but we do see that, what this bar shows you is always the first half of each year, how many Chapter 11 filings there have been. And you see a market uptick already in 2020 relative to 2018 and 2019. It's still a long way from what we saw in 2009, but again, it might still be early days. And again, maybe the government intervention actually successfully helped to stem some of these Chapter 11 filings in the first place. Slightly outside the model, but nevertheless kind of closely related, you could look at commercial mortgage-backed security markets. And there you see that there's a lot of commercial mortgages that are already in default. In fact, the default rate was about 7% in May. It actually became 10.3% in June. That's not on the graph, but that 10.3% was basically the same level as the peak that we saw in the Great Financial Crisis, which was achieved somewhere in 2010. So this is to say, to summarize the empirical evidence, there's basically a lot of distress in the corporate credit market, especially pre-government intervention. Government intervention seemed to have successfully stabilized some of the credit spreads, as well as potentially already averted some of the corporate bankruptcies. That said, it's definitely a very dicey situation, even kind of as we look to the second half of 2020. So now let me give you a little bit more detail on these programs, these government lending programs. So there's the PPP. We've actually had 2 rounds of this so far for a collective $671 billion, or 3.1% of pre-COVID GDP. What these loans are essentially are 2-year corporate loans. They have a 1% interest rate. So the banks are originating these loans. The banks are earning a 1% interest rate. The principal is capped at 2.5 months worth of payroll, and it's capped at $10 million maximum. Okay, so these are basically loans for small corporations. And then essentially the government forgives this loan. Okay, so the bank receives an interest, but the principal is forgiven 100%. Okay, so you could think of it it's as if the interest rate is negative 99%. And the Fed provides the term financing for this, and the Treasury guarantees the losses on these loans. The Main Street Lending Program is really a slew of like 4 or 5 different programs, which combine for about $600 billion. They target medium-sized firms. And what's different about these is that banks here are doing some risk retention, or have to do some risk retention. So again, banks originate these loans, but they have to retain a 5% to 15% share depending on the riskiness of the loan. These loans have a higher interest rate than the PPP. They have LIBOR plus 3% interest rates, and most importantly, they have no principal forgiveness. So these are regular loans, and like a more or less regular interest rate. And the size of the loan is tied to the EBITDA of the firm. And then finally, we have these corporate credit facilities. And again, there's like 3 programs here. There's the primary market corporate credit facility, which intervenes directly in the purchase of corporate bonds that companies issue. There's the secondary market corporate credit facility, where the government can purchase already existing corporate bonds, mostly investment grade, with one exception. They can also buy high yield ETFs. And there's the TALF, which basically buys asset-backed securities, like CLOs, for example. Okay, and so here there's kind of no subsidy component in the sense that the Fed is buying these securities at market interest rates. Of course, by the scale of its intervention, it may be changing the market prices on these assets. And so we're going to basically build each of these programs into our model. So now let me talk a little bit about the model. There's a lot of detail here, and I'm not going to have time to do this justice, but just give you a rough sense of what's going on here. Right, so this is kind of like kind of a triple-decker model of the economy where we have a household sector, a corporate sector, an intermediary sector, and a government. And so on the household side, there's basically two types of households. They're borrower households and saver households. Their only difference is that the savers are more patient than the borrowers, which is why they're savers and not borrowers. So starting with the borrowers here are going to be the shareholders of the firms, both of the corporate firms, the producers, as well as of the banks, the intermediaries. Okay, and I want you to think of the intermediary sector here as a broad financial sector, a broad levered financial sector. It's not necessarily just banks. It could also be non-banks that are levered. It could be insurance companies, levered life insurance companies, for example. And so what are these intermediaries? Well, they do what you think they do. They basically take short-term deposits from the savers and then transform these into long-term corporate loans. Okay, and so these corporate loans here are have long maturity, they're defaultable. And they also fund these loans with equity, which they raise from the borrowers. Okay, so these savers basically they have the following portfolio choice problem. They can either invest in short-term safe debt, which is equivalently deposits, or government debt. Why are deposits safe here? Well, because there's deposit insurance. Okay, so deposit insurance is what makes short-term deposits equivalent to short-term government debt. So the first asset is basically short-term bonds, risk-free bonds. The second asset that the savers can invest in is in corporate bonds. And corporate bonds and corporate loans here are the same thing. They're debt issued by the corporate sector. And so we're going to be able to play with how much of this debt is intermediated through the banking sector versus directly held by the saver. Okay, and so then the government basically, what's the role of the government? The government is going to be, spending money that it's throwing in the ocean. It's also going to be spending money on transfers like unemployment or food stamps, which goes into households' budgets constraints. It's going to tax households, it's going to tax corporations and banks. And then from time to time, it's going to have to bail out some of these intermediaries. So some of the intermediaries are going to default at some point. They're optimally going to choose when to do that, but at some point they might, their net worth may be sufficiently negative that they throw in the towel. And at that point, the government takes over these intermediaries, liquidates the assets, and basically makes whole the depositors. Finally, a word on the producers. The producers are, basically producing goods in the economy with the equity and with long-term corporate debt. Okay, so that's basically the model. So I want to give you just enough ingredients for us to be able to productively talk about this default friction on the corporate sector, which is kind of exactly the margin on which these government programs are going to intervene. Right. So just a little bit about these firms, these producers. They're producing with capital and labor in the standard Cobb-Douglas production function. There's two sources of aggregate risk in this model: aggregate productivity shocks Z and idiosyncratic productivity shocks omega IT. They have a second moment, a cross-sectional variance that is time varying, and that is the second source of aggregate risk in the model. Okay, so there's time varying dispersion. We're going to call this uncertainty shocks to the idiosyncratic productivity. Okay, so the idiosyncratic productivity realization itself is IID across firms, but the cross-sectional variance of it is persistent and is an aggregate shock to the economy. So basically, when you're a producer, you're going to be getting your own. There's a continuum of these producers. They're each going to get their own little idiosyncratic productivity shock, and some of them are going to end up defaulting. Okay, so how does this work? So basically, all these corporations have, they enter the period with some long-term debt that they have to pay off, and then the productivity shock realizes. Okay, and we're going to assume that the firms that have negative profit, and the profit will be endogenous, will be a function of the productivity shock, that those firms have to default. Okay, so this is going to be a model of liquidity default, not strategic default. Now, if a firm defaults, what's going to happen is its lenders, be it the banks or be it the saver households who directly lend to them, they're going to seize these bankrupt firms, unwind them, and basically there's going to be some debt weight loss associated with this bankruptcy. So what we're going to find is that there's going to be a simple default rule here in this model, where all the firms with low enough productivity realizations omega IT below some threshold, which is endogenous, omega star, are going to end up defaulting, and all the other firms are going to survive. Okay, so we're going to structure this model so that we can get aggregation across these producers, but we can still get fractional default. Okay, so we're kind of making exactly the right assumptions to kind of keep, in some sense, a representative firm, but still be able to talk about, you know, partial default where a fraction of firms default at some point in time. So at the end of the day, this kind of representative firm, you know, after kind of these default decisions have been made by, you know, a fraction of its members, is going to be solving a fairly standard corporate finance problem where the firm is choosing how much labor to hire. This labor is supplied by both types of households, both the borrower and the saver households, inelastically supply their labor. They're going to choose how much to invest, how much corporate debt to issue, and how much equity to issue. Okay, so we're going to assume that there's some equity issuance costs, you know, capturing some traditional corporate finance frictions. And then, you know, basically what gets us aggregation in this model is that all these portfolio decisions that these firms make are homogeneous in net worth. And so we get a nice aggregation result here. And so then the optimal capital structure in this model kind of follows a standard trade-off where basically debt is cheap for a variety of reasons. There's the tax, the standard tax advantage of debt, but also because equity issuance is costly, and also because savers are kind of more patient. And on the other hand, there's costly bankruptcies, okay? And so to some extent, producers here are going to internalize the effect of their debt choices today on the default rate in the next period. So there'll be kind of an interior optimum where there's a well-defined capital structure. So now let me say a few words about the banks. So these banks, you know, you may recall, are owned by the same shareholders who own the non-financial firms. They're also going to face costly equity issuance, and they're also going to solve a portfolio choice. So the portfolio choice that the banks make is basically how many corporate loans do I make and how much deposits do I raise, okay? Now these loans, remember, debt is long-term. These are long-term loans. So on the outstanding debt that is still performing, they're going to receive a regular coupon payment, you know, as well as some amortization. And on the assets, on the loans that are defaulting, they're going to basically get a liquidating dividend. Basically, they're going to run that firm for one more period, pay off the employees, and then basically push the firm through liquidation. And in the process of that liquidation, a fraction zeta of the assets of the firm and fraction zeta of the output is going to be lost. A fraction eta of which we're going to say is the deadweight loss to society. Okay, so that's kind of the first source of loss, this kind of deadweight loss of default. That's the first place where that shows up. Now, these banks, as I already mentioned, they have deposit insurance, which in this model is equivalent to limited liability. So again, there's going to be a continuum of these banks, each one of which is going to receive an IID idiosyncratic profit shock, and they're going to optimally choose to default or not. Okay, so the bank's problem is one of strategic default. And so normally, you know, in this model, banks are going to have franchise value. So normally they're not going to want to default. They're going to want to stay alive and preserve the franchise value. But if they get hit with a bad enough shock, their net worth could get low enough that they'd rather throw in the towel. And by throwing in the towel, I mean basically the FDIC comes in overnight, over the weekend, you know, takes over all the assets of the bank, makes whole the depositors, and basically eats the loss. And so when that happens, there's again going to be a fraction zeta of the bank or bank's assets that is lost to the government, a fraction eta of which is a deadweight loss to society. Okay, so there's two sources of deadweight loss associated with corporate bankruptcy and associated with bank bankruptcy. And then finally, these banks are subject to a regulatory capital constraint. You could think of this as being potentially microfounded by moral hazard. You know, because they enjoy deposit insurance, they have risk shifting incentives. And so it's important for the government to make sure that banks are well capitalized. They do this through a Basel style regulatory capital constraint. Okay, and then finally, taxation works the same as for corporations. Banks are taxed on their interest income. They also enjoy a tax shield, and they have to pay for deposit insurance. So to close the model, let me say a few words about you know, the two types of households as well as the government. So these borrower households, remember, they're the shareholders of the bank and the intermediaries. They're going to receive dividends from both of them, and they're going to have to recapitalize the defaulted producers and the defaulted intermediaries. So they're going to replace them at the end of the period with new firms and new banks that look identical to the surviving ones. Okay. What about the savers? So the savers here, remember, they have this portfolio choice problem where they invest in risk-free and in risky debt. Risk-free debt is either government bonds or deposits. Those are equivalent, and they can also directly invest in corporate bonds. So the assumption here is that, in general, when households directly hold corporate debt, they can do that just like banks can make corporate loans, but the households are less efficient than the intermediaries at doing that. Okay, so you could think of this as capturing some sort of monitoring advantage or screening advantage that the intermediary sector has relative to the household sector. And so if that cost is large enough, you're going to endogenously have an intermediary sector that arises in the model. And finally, the government, is actually kind of an important player here, because we want to be thinking about, COVID and the role of the government, right? And so the government here is kind of a passive entity in the sense that it follows a set of tax rules. There's a tax rate on labor income, on corporate and on intermediary profits. There's also deposit insurance fees that the government collects. And it spends on discretionary spending, which is basically a loss of resources to the economy as a whole, but also on transfer spending, which is unemployment, food stamps, and so forth, that enters into households' budget constraint. And it spends on intermediary bailouts. If it has to bail out the banks, that ends up being an expenditure as well. So the government satisfies a period standard budget constraint where its revenues have to equal its expenses. So its revenues plus the new debt that it issues has to equal the debt that it needs to repay plus the government spending. There's one kind of technical detail which is kind of interesting, which is that, by the way, and the taxes and the spending are going to be cyclical, with the cyclicality parameters kind of taken from the data. Okay, so the model is going to have pro-cyclical tax revenue and counter-cyclical government spending, so that things like unemployment insurance go up, spending, discretionary transfer spending go up in recessions, like now. Now, one thing, though, that you have to take care of is you have to make sure that the government debt stays risk-free, and that's actually not obvious. And so for that to be the case, you have to essentially let the tax rate depend not just on the state of the economy, but also on the level of debt. Okay, so if you want the level of debt to be stationary, you have to make it so that when government debt becomes too high, let's say higher than 100% of GDP, then the government has to start, increasing the taxes. Okay, so that's the baseline model. In that model, we're going to have a COVID shock. In a nutshell, how do we think of the COVID shock in our model? We think of it as essentially, a few different things. It's basically a decline in average firm productivity. It's an increase in uncertainty in the cross-sectional dispersion of productivity. So some of that is kind of a regular transition to the high uncertainty regime, and some of it is an additional kick in productivity dispersion, which is a one-time thing. And then finally, it's a labor supply reduction, which, we think captures things like, households had to stay at home, or they had to stay home to be with their kids, or they were sick because of COVID and they couldn't supply any labor. So it's this combination of three things. It's basically, the average productivity of the average firm is low. The dispersion in productivity is very high. You could think of that as capturing the heterogeneous experience across industries. Where the travel sector gets hammered, but the tech sector is doing really, really well. So there's an increase in dispersion in productivity, and it's a decline in labor supply. Okay, and we calibrate these numbers so that absent an intervention, there's something like an 8% decline in GDP in 2020. So the model is annual. So basically, that sounds about right. I mean, right now I think we're kind of on course for an 8% GDP decline in 2020. So then, we have to make assumptions on the recovery path after this kind of MIT shock, this one-time COVID shock evaporates. And in the first set of results, we're going to assume that everything goes back to normal, except that it's going to take a while for the economy to kind of move out of this high uncertainty state. It's going to follow a persistent Markov process that is going to only slowly mean revert. But other than that, all these MIT shocks kind of dissipate after one period. At the end of my talk, I'm going to give you a second set of results where instead, once the pandemic hits, we're going to assume that there's a 50% likelihood that it lasts another year. And on top of it, from now on forward, these pandemics are going to recur with 1% probability every year. Okay, so think of this as kind of like a disaster. These pandemics are now going to be in the information set of the households. This is my, Laura Veldkamp, my colleague at Columbia, has some work that talks about the scarring effect of recessions, which kind of captures some of that spirit as well. Where, once this is in our information set, kind of from now on forward, the world looks different. So let me say a word about kind of why these government bridge loans, these PPP loans and Main Street lending programs in the model, why they work. Okay, so the way the model corporate default works is that it's basically a timing. And the timing is really crucial. So the way the intra-period default decision is structured in the model for firms is as follows. The beginning of the period, the aggregate DFP shock realizes. Firms choose, they're given capital and labor and a certain amount of debt to pay off that they inherited from the last period. Then firms choose how much labor input to demand, and they have to decide whether to operate or not and pay a fixed cost. After they make these choices, the idiosyncratic productivity shock is realized. Okay, and so now, as you can see in that equation here at the bottom and in the middle of the slide, basically now it's possible that their productivity shock is so low that they can no longer pay their workers and service their debt and pay this fixed cost of operation. And so their profit turns negative. And so firms with a low enough productivity shock, basically, below omega star are going to default. Now, how could bridge loans help here? Well, what these bridge loans basically are kind of intra-period loans that allow the firms at time 2 to essentially borrow some additional money. And you can imagine that these bridge loans are basically proportional to the wage bill, as they are in the PPP program. Okay, so imagine there's a fraction A bar, that I can now borrow in addition. Even if this debt is junior to the old debt that I already had outstanding, basically what this is going to do is going to lower my default threshold. And so now there's going to be more firms that would have defaulted that are no longer going to default, because of this additional bridge loan. Okay, and so this is the margin in which the government intervenes. It basically allows firms to basically smooth out at least some firms smooth out this idiosyncratic productivity shock and avoid this kind of liquidity default. So in the model, we're going to capture kind of both the government guarantee aspect of the loans as well as the debt forgiveness aspect of the loans. And in the model, we're going to be allowing to deal with kind of partial government guarantees and partial debt forgiveness. Okay, so the PPP in the model is going to have full debt forgiveness, is going to have a full government guarantee, it's going to have a 1% interest rate for the banks, and it's going to be sized exactly like in the data. The Main Street lending program is going to be sized like in the data. It's going to have this higher 3% interest rate. It's going to have a 5% risk retention, so only a 95% government guarantee, and it's going to have no debt forgiveness. And then these corporate credit facilities in the model are going to be direct purchases of the government of corporate bonds, again, of the same size as in the data. And so I'm going to refer to the combo program as basically the combination of all these programs. And then the last program I'm going to consider is a hypothetical program. We're going to call this a conditional bridge loan program, where the government has this amazing ability to exactly target which firms need help. Okay, both on the extensive and on the intensive margin. Okay, so who is at risk of default, who has low enough productivity shocks that absent help they would default, and how much exactly do I need to lend to these firms to avoid their default. Okay, and so that perfect targeting is essentially going to be able to eliminate most of the default, and it's going to cost the least amount of money because I'm not going to give anybody any more money than they need to avoid default. Now, in practice, this is not a feasible program. This, it would impose a huge, informational requirement on the government. There's obvious kind of moral hazard issues with it, but it's a useful kind of benchmark for us to kind of compare these actual programs in 1 through 4 to. So first, let me show you some kind of short run and longer run responses of macro and financial variables. Okay, so turning to the results now. So the first thing is kind of what happens to GDP, consumption, and investment. And as you can see, absent any policy, so this is the laissez-faire, the government basically did nothing. You see that there would be this kind of 8% drop in GDP in 2020, and then essentially snap back in 2021, but a very kind of long tail. It would take 25 years for the economy to kind of fully recover. Okay, so there's this persistent aspect to the recovery. Essentially the long run cost to GDP is something like 30% instead of 8%. It's like 3 to 4 times as large as the 1 year effect. But there's a massive kind of shortfall relative to trend. And some of that shortfall comes, so a lot of this persistence is endogenous. It comes because we're not investing a lot this year. So now the capital stock is kind of permanently lower. It takes a long time for that to recover. Some of it is the banks get hammered, and so their wealth gets depleted. And again, it takes a long time for that financial wealth to rebuild. So there's kind of a lot of endogenous amplification in the model at work here. Consumption falls 5%. And then, as you can see, there's basically a huge kind of primary deficit in 2020, which I'm going to show you in a little bit, is due to the government having to bail out the financial sector in 2020. And so government debt as a result spikes, and that takes a very long time to recover. So this picture shows that, even if we kind of get this quote unquote, like this is not quite a V-shaped recovery, but it's like a V with a, I guess people call this the Nike swoosh kind of a tail. Government debt takes a very long time to return to pre-COVID levels. So what about the intervention? So if we compare this path to the path that arises with this combination of policies that we kind of think as a good description of the real world intervention, we see that it's really effective in the sense that it helps reduce, for example, the decline in investment from 70% to 40%. Okay, it's still a large decline in investment, but it's not nearly as large as it was before. And it kind of, if you kind of integrate between the green line and the blue line, it does kind of mitigate quite a bit of the losses in GDP and in consumption. Okay, but the primary deficit in 2020 is just as large because now we have to spend all this money on all these programs instead of on the bank bailouts. Okay, government that does return a little bit faster to kind of its pre-crisis levels than under the laissez-faire economy. Now, finally, let's compare this to this hypothetical conditional bridge loan program where the government can perfectly target the firms that need help. And you see that, this program is a lot cheaper. It kind of has a much lower fiscal cost. Government debt doesn't go up nearly as much. And it shaves off another 5% or so in cumulative output losses that are avoided. So now let me give you a little bit more detail on these results. Even though I've kind of given you the main gist already, right? So these are now looking at the 1 year 2020 impact. And as you can see, the PPP and the mainstream lending program relative to the do nothing scenario, they eliminate about, 40% of defaults, of corporate defaults. The default rate instead of being 12% is about 8%. Similarly, the loss rate. Now that's really helpful because by inflicting fewer losses on the corporations, essentially you're also inflicting fewer losses on the intermediaries. And so intermediary failures, rather than being 40% in the laissez-faire economy, which is kind of an epic financial sector collapse, instead are only like 10% under the PPP program, and under the combo program, something like 6 or 7%. Okay, so the decline in intermediary assets is kind of, instead of being 70%, it's only 30%. It's a massive difference. Just one note on the corporate credit facility program. That one, remember, is the intervention in the primary and secondary corporate bond markets. That one is not nearly as effective at reducing default rates, but it is quite effective at reducing loan spreads. And by reducing loan spreads, it's basically propping up the value of corporate bonds, which is helpful for the banking sector, right? So the banking sector essentially enjoys a mark-to-market gain on its credit portfolio, and that all else equal helps it kind of avoid some bankruptcy. You do see some reduction in intermediary failure and kind of less of a big hit to intermediary net worth. And so to sum it all up, what are the welfare implications here? So let's just focus on the right panel in the interest of time. What we're doing on the right panel is we're comparing each of these programs to a do-nothing scenario, and we're aggregating the welfare, the value functions of the two sets of households in this economy, the borrowers and the savers. So relative to do-nothing, the PPP is kind of the best of these three programs, and combined, we're getting a welfare gain in consumption equivalent units of about 6.5%, which is very, very large. Now, compared to this conditional bridge loan program, this kind of a hypothetical, perfectly targeted program, you see that welfare would have gone up even more, but the gap is not that large. So from this graph and from this result, we conclude that the government was not too far off. Regardless, they mounted in a hurry a bunch of fairly blunt programs, but at the end of the day, it's not that far off in aggregate welfare relative to this kind of perfectly targeted program, okay, which we think is an interesting result. I also want to draw your attention to the fiscal implications. So I've already mentioned this, absent any programs, there is a massive bailout of the financial sector, which costs something like 12% of GDP. Whereas in the combo program, we're spending 10% of GDP on the cost of the program. So at the end of the day, the total spending is about the same. Comparing the blue graph here and the green graph here, the government ends up spending the same amount of money, but in one case, it's spending it on bank bailouts, in the other case on programs. There are some strong effects on interest rates in this model. The equilibrium interest rate is, the interest rate is determined in equilibrium. When there's a massive expansion of government debt, essentially interest rates go higher. And so this, You can interpret this as, maybe a counterfactual implication of the model, given how low interest rates are right now. But this has to do with kind of the assumption that we're making here that growth, that this shock is a one-time thing, and so expected growth is actually very high, conditional on being in the COVID crash. This would be fixed with this new normal economy that I mentioned before. Or you can interpret this as a warning sign that interest rates and government debt are about to go up, kind of given all the massive spending that we've done. So let me just, this is my timer going off, which is a sign that I'm about out of time. Let me just spend one last minute, if I may, on this new normal. Okay, so what we do here, as I said, is we kind of introduce this possibility of a pandemic disaster, and this changes very little in terms of the short-term impact of these graphs that I've shown you, except for the interest rate graph, which now falls. So short-term rates actually do decline because now the COVID scenario is expected to last for another period with high likelihood, and so that ends up lowering expected growth. But where the difference is more interesting is in the long run. So what I'm doing here is I'm comparing steady states of these two economies in the long run, and what we're showing is that just this kind of 1% probability of having pandemics in the future, makes firms more cautious, basically leads to a smaller corporate sector in the long run that is less levered. It also leads, as a result, to a smaller banking sector. There needs to be less intermediation done, but also a riskier intermediary sector, because essentially there's a little bit more tail risk now in the economy. And it leads to some disintermediation. So there's kind of some, if you like, the corporate bond market becomes larger relative to the corporate bank, the corporate debt, corporate loan market. And then finally, all of this ends up lowering GDP, kind of the smaller size of the intermediary sector, the smaller size of the corporate sector, and the higher risk ends up lowering GDP and aggregate consumption by about 0.5%, kind of permanently. Okay, so the economy becomes larger, and obviously that's bad news for the agents. The agents would be willing to give up something like 8.7% of wealth in order to avoid living in this pandemic economy. So let me conclude. We've done a quantitative evaluation of these government lending programs. Overall, we think that they have been very effective at short-circuiting this financial sector collapse, and that they have avoided like a good chunk of the corporate defaults that otherwise would have happened. We do predict a large increase in the primary deficit, but this increase would have happened anyways. And then we think there's a range of things you could do with this model. You could, try to build in kind of a higher frequency dynamic into the economy, have multiple sectors, one sector that's affected by COVID, another that's less affected. You could have more aggregate demand frictions or labor market frictions. So let me leave it at that, and I look forward to your questions.
So thank you. As president, let me thank you very much for sharing these insights. Impressive, very, very timely, of course. Can I take the first question?
Sure.
So let me, so I have like 2 points that I wanted to ask you about. So the first question is leading directly to your conclusions. I mean, you said there's things you could do. And from my very limited point of view in these things, I saw some of the assumptions you made on the corporate and the long-term debt versus short-term debt, and corporations have an optimal debt structure, an optimal capital structure. So all that might be different than what you're assuming. So all these things lead me to the real question. So if I were a political person, I would take these things and, take these numbers seriously and say, okay, this was a fantastic, fantastic effort on the part of the Trump administration. It's 40%, 30%. So my question is, I'm sure what you're showing is correct, but how confident are you in the actual numbers? And the second question is also, since I'm working on credit spreads and things like that, I just wanted to get your take on this, because that was very interesting. In the previous crisis, the spreads shot up to about 20%. Here, even in the worst time when there was no certainty about government, it shot up to 11% and then went down a lot. Whereas in the previous crisis, I'm looking at the numbers, even 2008, 2009 stayed about 8 or 9%. Now we're already below that. So in any comments on that in terms of how the crisis was evolving and government support? And of course, we keep in mind that even the previous crisis, the government did do a, until then, unprecedented program to help the economy.
Sure, thank you. Thank you for these great questions.
A little long, yeah.
So just briefly, I would say one big difference with the great financial crisis is that the banking sector entered the COVID crisis much better capitalized than it was before. And in fact, our calibration takes that into account. So, you know, we're starting from a much better capital position in the banking sector. And so that makes a huge difference for all these spread dynamics in the model as well. In terms of the, in terms of the decline in these credit spreads, I would attribute that to a large extent to these government interventions that we're trying to capture here. And the model actually does generate a 300 basis point decline in the corporate bond spread after these interventions. So at least that's consistent. Now, in terms of how to interpret, how confident am I in the numbers? Well, you know, in this line of work, what you do is you try to match a million moments, and you try to match history. And then you cross your fingers and hope that the world, the structure of the world that you've built, you know, will remain the same going forward. And if you've matched enough moments, you can kind of increase your confidence. So we match, you know, a million moments of the U.S.
I'm sure
leading up to the crisis. And so that's about, you know, as good, I think, as we could do. You know, but of course, look, you can always add more ingredients to the model. This is not a complete model of the economy. I think, in particular, on the demand side. You can imagine adding a lot of kind of demand frictions and nominal rigidities that we haven't done yet.
Yeah, but I wanted to press you on the policy issues, the numbers. In other words, because this is a hot topic. I mean, this is not just a research topic. It's in the middle of the political campaign. So how confident are you that it's 40% versus 30% or 20%? Or is it 45%? Or you're saying just what you said now, that it is the best model? I'm sure, you know, I know your work, and I'm sure it's the best model that one can come up with. So is there any numbers that you could give us if I were a journalist?
Yeah, I don't know. Look, I think the best way to answer it turns out to be a very difficult question. And, you know, I'm not sure my model is the best model there is, but, you know, I am confident in it. You know, the way you would answer this is you would see, well, if we start varying kind of key parameters, how much do these numbers change, right? And so you want some variation, because otherwise your model is not identified. If nothing changes when you change all the parameters, that's a bad model. But you don't want things to be too, you know, too volatile, because, you know, then, you know, it'd be hard to give policy recommendations. So let me just kind of leave it at that. You know, you need to do these types of sensitivity analyses to increase your confidence in these numbers.
Thank you. Thank you.
So Stefano, I'll let Julian talk first, and then we can, you know, if we go over like 5-6 minutes, that's totally fine. Because Julian has a question, so I'll ask Julian to talk.
Yes, very interesting paper. So I have a question regarding multiplicity that I don't know if it's going to apply in this model or going to depend on the assumptions. And if not, I want to know how you think about, which is the following. The cost of these programs is going to depend on the ex post realized level of default. So if ex ante the firms expect a lot of default, that's going to be very costly. We're going to see a lot of defaults. And so in the future, taxes will have to rise, the debt is going to change, and so interest rates are going to change. And that's going to make that ex ante, the NPV of the firm is going to be quite low, and we see a lot of defaults. And conversely, if we expect very little default, taxes are not going to rise that much, and so ex ante, the NPV is kind of low. So that can rise, these programs can generate a type of multiplicity with very high defaults or very low default. So I want to know if this happened or not in the model, and if not, how to think about, because that's about that. Thank you.
It's a good question. So I guess you're asking whether this could happen, for example, through taxes, right? So what's true is that the model is very, very nonlinear. And so you can easily, so multiplicity kind of shows up in terms of like nonlinearities where, you know, if the banking sector in particular is very poorly capitalized, then basically all hell breaks loose in the model. So, you know, you could get situations where, you know, basically there's large deficits, the government needs to, there's a massive government bailout that to pay for this, the government needs to raise taxes substantially, which now affects corporations as well. And so this all feeds back. So there's no multiplicity, I think, per se, in the sense that you're describing. Everybody here has rational expectations. Everybody understands the structure of the economy and the laws of motions of the state variables. But you do get these very nonlinear dynamics when banks have very, very low wealth. And so that we see very strongly. I actually think it's an advantage of these type of models. We solve these models with global nonlinear solutions in order to capture these type of nonlinearities.
Yeah, Stefano, you want to?
Yeah, so that was great, Stijn. I had just a couple of questions. One is, when you kind of went very briefly on the new normal, kind of where there's a recurrent pandemic. What were you assuming when you're solving this model about future policy? Are you assuming that the same policies is going to be applied? Let's say the same bailout policies versus the PPP, whatever, is going to be applied in the future? Like I just didn't understand what you're assuming.
So when we do the new normal, we're comparing. So we're solving when we're solving the new normal for each of these policy experiments as well, right? So in that case, the policy is there. So we're always we're solving a model where there's a new normal and there's no policy. We're solving a model where there's a new normal and there's a PPP, a new normal and a mainstream.
Every time the pandemic hits in the future, the PPP will be reapplied again.
Yes.
Because I was thinking that your model actually, because you have all these different policies, should allow you to say a lot of interesting stuff about moral hazard, right? Because all these policies are very different in terms of who actually benefits from the policies, and so the moral hazard implications are also very different across policies. And I just think it seems like something very interesting.
Right. And it's a good question.
Sorry, just to conclude the question. The other thing that would be interesting is to think about the effects of policy uncertainty, because you could say maybe in the future, different governments would apply different policies. And so there's another kind of entire set of things you could study with this model.
Yeah, these are great comments. I think we could definitely go in that direction where there's some uncertainty. There's some interesting related work, I think, on like tax uncertainty, for example, and like the work that Lucas Schmidt and co-authors have been doing in the context of like sovereign debt and corporate credit risk, which thinks about tax uncertainty. And this would be about like bailout uncertainty, or I think I agree with you. That'd be a very interesting direction to push.
Thanks.
I have a comment for Julian's question. I think, Stijn, I think you have one period debt in your model.
Government has one period debt, yeah.
One period, right? So I think that's the reason it doesn't have multiple equilibrium, because once you have long maturity debt, then some expectation about what's going to happen in the future could happen, and you could have multiple equilibrium. But I think not one period debt rule out that issue. Stijn, do you want to talk about? I was wondering if you can talk something about optimal policy.
So I mean,
one thing would be, would it be optimal not to give any tax benefit of debt?
Yeah. So the model is a good laboratory to study these type of questions, clearly here there are kind of externalities with having too much debt, right? So I think any benefit to the debt that is given, if you remove that, you would potentially improve welfare. We haven't done this calculation. It's a good question. It's easy for us to do, to kind of do actually at some point in our previous paper we did do a calculation removing the tax advantage of debt. And I guess
the exercise is key. There is always equity issuance cost. If we think of that as some fundamental frictions, the question is, how do you write?
Yeah, it's easy to do. I think it's a nice environment to do this type of experiments. What the model is much harder, what is much harder to do is an actual optimal policy experiment, like some sort of, first best. It's a good environment to kind of vary sizes of programs. So we do in the paper, there's a number of exercises that I will refer you to in the paper, which are about, the forgiveness. What fraction of forgiveness should these loans have? Another one on, what fraction of government guarantees should there be? Another one on how large should the PPP be? So we do an experiment where we double the PPP. Do another experiment where we give the household some transfers, like in these $1,200 checks that Americans have received. So, you can layer in all of these type of real world policies in the model. It's good for that. It's kind of it's too hard a model to solve to do an actual optimal policy type of exercise.
So Hui has a question, so I'm gonna, we could talk.
Okay.
Wait, go ahead.
Can you hear me?
Yeah, we can hear you.
I like the paper a lot. This provide a framework, right, for understanding how government should react to the academic actually shock. So my question is, right, so for my personal, right, I'm worried about inflation. So probably government actually can finance, right, through tax or through inflation. What do you, I mean, money is not in your mode, I know, because model you write it very complicated, but just like what is your thinking, right, about the outlook, right, of the inflation? And also, right, so we talk about, right, the Fed actually flood the market with lots of money. So my question is that, right, do we have a bubble now actually in the financial market, right? So how actually Fed are going to unwind, right, these inflations in both actually, right, the goods markets and the financial market?
Yeah, these are great questions. We actually have another project, a couple of papers with a different set of co-authors that thinks about this question, with Hanno Lustig and Zheng Yang and Mindy Xiaolang. And one of the points we make in that paper is that inflation, like surprise inflation, doesn't really work very well to erode government debt, because essentially the maturity of government debt is too short. It's only about 4 years in the data. And so you can't really generate enough surprise inflation to make a meaningful difference. Ricardo Rees actually makes that same point in a paper, like 10 years ago, that ultimately this is not a very promising channel to pay back government debt. So I'll refer you to Ricardo's paper on that point. And so I think, thinking more carefully about these questions of, how does the Fed and unconventional monetary policy, and the fact that the Fed is buying all this government debt and then issuing reserves, which have to be held by the banking sector, or how does that, in a model with frictions in the banking sector, how does that affect the macroeconomy and the financial market? I think it's just a great set of questions. So Vadim and Tim and I are working on a project along these lines to think more carefully about that. So these are very good questions.
Okay, I think we are about to, the next session start at 1:30, so maybe this is a good time that please join me in thanks Stijn for giving us the wonderful talk. Especially there's a big tropic storm in New York and he has to go to his office. Thank you, Stijn.
All right, you're welcome. Thanks a lot for the questions.
Thank you very much for coming. Thank you.
Bye.
Bye-bye.